when opportunities come along, you have to take them. And if they don't work out, you kind of need to look yourself in the mirror and say, no, this isn't the right thing, and make them move on, which is maybe even a harder decision than taking the risk in the first place. The market, the nature of the industry is changing significantly, and that by definition means that to be a real estate investment manager at the forefront of the industry, you need to have different skills and be able to offer investors different things than you needed to even 5 years ago.
Welcome to the People Property Place podcast. Today, I'm delighted to say that we're joined by James Lass, Head of Operational Real Estate at Swiss Life Asset Managers. Swiss Life Asset Managers has more than 125 years experience as a real estate investment manager in Europe. In the UK, they provide three principal investment services to a broad investor base: UK core funds, UK separate accounts, and joint ventures, and UK value add strategies. Prior to joining Swiss Life, James worked at Schroders as a fund manager responsible for the Schroder UK real estate fund. He started his career at Allsop before moving to Savills. And like I said, I'm delighted that James is joining me on the podcast today. So welcome to the show.
Thanks, Matt. Thanks for having me. Looking forward to it.
Not at all. Well, look, I'm really excited to kind of unpick your background and career and dive a little bit deeper into how you're seeing the market at the moment. Like I said, off mic, you're a hard man to try and pin and do a little bit of research on in terms of what you've been working on. But I will do my best to try and pull it out of you and share some of those nuggets with everyone. But where we start this podcast is trying to understand how and why you got into real estate, because certainly of the research that I did do, you didn't go straight into it, or you didn't study it straight off the bat.
No, I didn't study it. Did politics at university after I left school, and so had a passing interest in real estate, but hadn't really joined the dots over that and the prospect of it as a career. And it wasn't until I got work experience, an internship in the summer holiday before my last year of my degree, that the penny dropped, and I realised that real estate as a career was a viable and quite an exciting option. And I'd seen some friends get similar work experience opportunities, and it looked like the right combination of being out and about and not completely desk-bound, that old thing about dealing with a tangible asset and something that's integral to everyday life, and an industry where you can be sociable and use people skills. So a good mix. And that led me to doing the masters at what was City straight after university, over 2 years part-time whilst working.
So did you have any friends or family in property, or where did kind of a career in real estate enter your psyche? Not
really. I mean, there are some family members in the industry, but not close family members that I'm in regular interaction with. So it was more through, as I say, seeing friends get work experience, them enjoying what they were doing and it looking exciting, and so following up and getting that experience myself, and then it sort of snowballed from there, really.
So did you get the job? It was Allsop you started, right? Well,
I actually worked for a startup development consultancy straight out of university, where the owner of that business I'd met at my internship, he'd gone out on his own, asked me to come along with him. It was a small team at the time. That business actually failed after a year, and then I moved on to Allsop's. But for that year and the first year at Allsop's, I was also doing the masters part-time in the evenings to do the conversion to allow me to do the RICS qualification.
And you'd self-funded that, or did you
Yeah.
manage? Okay, fine. So quite a big kind of commitment at that stage. And
Yeah,
having already done a degree.
Well, I think I was definitely ready to get out and start working. And so I wanted to do real estate. It was almost by default that if you went into the industry at the time, you got the RICS qualification. I didn't want to do another full-time year of study. And that was fine because City offered the opportunity to get that conversion course qualification part-time. So it worked really well for me.
So in terms of that first year, the kind of the business failed, but you got a little bit of experience in studying part-time. How did Allsop come about, and what did your role look like there?
It was through a connection that I'd met working for this startup. Startup was a development consultancy. It was trying to do all kinds of stuff from advising developers through the planning process, through to actually developing out buildings, and then more funky stuff like football stadia development. And one of the contacts I knew there was I met that was very well connected within the industry, and actually taught me the importance of having a sponsor, someone who's experienced within the industry, who you can lean on for advice, but also who's well connected, that can help you when it's needed. And that was very early in my career, and absolutely anyone who's looking to get into real estate, I mean, we all know the power of networking, but early on in my career, I found the benefit of having someone who effectively sponsored me, put an arm around me, and helped me out. And it's just hugely beneficial.
And kind of what helped you break down or understand the different areas and different routes within property and where your career could go?
Well, more had connections into the various surveying practices that when I was looking for a job on a graduate scheme, effectively a year into my training, could help me get in front of those people.
So you got in front of Allsop. Did you get in front of any other shops, or?
I saw 2 or 3. I was actually applying outside of the normal graduate application process. So all the surveying practices had made their choices for that year. But Allsop's was, I actually knew a couple of people at Allsop's already. And so I got in front of the head of graduate recruitment there and hit it off, and got an offer which I snapped up.
So you straight into the investment team, because you were, as you said, you were off rotation, or were you? Sometimes that happens. You just get kind of siloed in a team where they need additional capacity, and then they'll second you or kind of lend you to the valuation team just to kind of tick that off with your letters. Or was it very much a rotational program?
It was very much a rotational program, but because I was joining at sort of in the middle of the year, I did exactly that. I got put where they needed me. So my first 6 months was in the residential auctions team, which was awesome, like phenomenal. Team ethos, which was needed to pull the whole auction process together. Obviously, it was still done physically back in the day. But I remember my first day, I walked in, I was handed keys to a Renault Clio and a road atlas and a load of addresses, and told that to come back in a week with a load of photos. And I had to go and inspect properties in places around the country I'd never heard of before. So in terms of broadening my horizons and giving me a grounding in the UK real estate market and different areas of it, it was a very good and very quick learning curve.
Where else did you rotate, and did you kind of find your niche after a few different rotations?
I went straight from there to investment, and apart from doing a few months in valuation, which you needed to do to get that box ticked and to obviously learn the skills required, I spent the rest of the time in investment until I qualified. And
then having qualified, stayed in investment?
Yep.
And what was that kind of national commercial investment? Were you focused on offices, industrial, retail probably at the time, the major asset classes?
Completely cross-sector. Allsop's had both a national and a central London investment team, and I was split broadly between the two in terms of how my time was spent. So again, getting experience of all different sectors, all different markets around the country from a geographical perspective. And I was there a year post-qualified, and I was definitely leaning towards more a central London theme. I was probably enjoying that side of the work more. And I had an opportunity to move to Savills a year post-qualified to focus on central London, which I did.
How did that come about? Is that Savills were beating you to the instructions, or?
They picked up the phone because you know what it's like. It's a small marketplace. Within a year of being in the market, I knew most of the central London agents, and they were looking to recruit, and so literally just picked up the phone, had a coffee, and it went from there.
Why? I always find it intriguing when people move from advisory firm to advisory firm. Why did you change? I know there's non-competes and other challenges around it, and of course you'd have probably received a bit of a pay bump or as an incentive to move. But why at that stage did you pivot?
I wanted to focus on central London, and as much as I love my time at Allsop, and I'm still very close to the firm, a fantastic outfit, I really wanted that specialism at the time. You know, I'd always lived in London. I went to school in central London, so I knew central London really well. I was excited about what was going on in the marketplace, the changes that were going on, both in terms of the growth of London as a market, the influx of international capital. So it was an exciting place to be operating. And so when the opportunity came along to focus solely on that market, at that point in my career, I felt that was a good thing. And throughout my career, I've focused on lots of different areas at different times, at sometimes a lot of areas at the same time. But then it was the central London market that was most exciting to me.
And that's probably one of the, if not the most kind of prestigious seats, right? Central London capital markets at that particular time and stage. Yeah,
probably. I would say so. I think everyone was very much coveting the place on an investment desk. Savills, just a fantastic place to learn, and very much devolve responsibility to you. You weren't spoon-fed, and so for me, early in my career, having to stand on my own 2 feet with my own instructions, try and do deals was a really good thing.
So you were at Savills just shy of 4 years or so. Yeah. What changed, and why did you look to flip over to the principal side?
I realised pretty early on that I wasn't a brilliant agent, and that I wanted to be more involved with assets longer term, rather than just focus on the front end and the back end, the brokerage side of things. And so probably 2 years into my Savills career, I sort of mentally got into the place that being on the other side of the fence was what I wanted to do longer term. And then it was about the right opportunity. Really enjoyed my time at Savills in the same way as I had done at Allsop's. Phenomenal bunch of people. A lot of the people that I work with are still there, and I left there 2006. So it just shows you the nature of the place. But when the opportunity came to move client side, I actually thought I'd end up at a property company, one of the listed or probably private property company, because the sort of clients I was working with at both Allsop's and at Savills was more of that ilk. But Schroders was a business that I'd been involved in deals with, so I knew the people there. And actually similar to when I moved to Savills, they were looking for someone to come in and do effectively an in-house transactions role. And so I was approached, and again, the conversation took off from there.
And you joined in November 2006, getting to the top of the market?
Phenomenal timing. I mean, I know that they say that you make your own luck through hard work, etc., which is true, but you definitely need a bit of luck along the way. And whilst I made the game plan to move out of agency and go client side, I think the timing couldn't have worked out better for a couple of different reasons. Firstly, agency was a really difficult place to be within sort of 12 months or so of me leaving, and also because of what was going on at Schroders. Around the time the market started to turn, it gave me the opportunity to get very involved and sort of push myself into the spotlight a bit, which ended up being a good thing longer term for me there.
What do you mean by push yourself into the spotlight?
So I had probably a year, 9 months to a year of doing the day job of buying a few buildings, getting used to transacting from a client's perspective rather than an agent's perspective, understanding what the requirements were of the various funds and sourcing assets that fitted those requirements, then going through the transactional process. I was spending most of my time working on the main UK focused fund, which was the fund that I ended up running a few years later. That fund, earlier than some of its peer group, started to suffer from redemptions as the market started to turn. It adopted a slightly different strategy to its peer group, in that it said it was going to pay out those redemptions rather than defer them. So we had some bit of pressure to realise some cash through sales, as we promised the investors we were going to pay them out by a certain date. And with me in that transactional role, it meant that there were quite a few eyes on me and what I was doing with those sales to enable those redemptions to be paid out.
Was it a retail fund or it was an institutional grade fund? So
yeah,
we
had a bit of time.
So you had a bit of time. So can you just run through, just so someone hasn't heard about a fund or a structure or how it works in terms of redemptions? Can you just
sure.
give me a bit of an overview on that? So
the fund had redemptions requests, if there were any, would come in at the end of a quarter. And then the fund had up to 90 days to pay out those redemptions, or if market conditions dictated that it couldn't realise assets in an orderly form, it had the option to defer those redemptions and pay out at a later date. As I say, it chose to take the former route and honour those redemption requests, but the fund wasn't holding any cash. So we had to liquidate assets to do that. And so we had to go through a whole exercise around fundamentally what assets do we not want to hold longer term. We're in a market that's falling quite rapidly and continuing to spiral. Can we get those assets out in time at the right price and protect the assets that we want to hold on longer? And in the end, we sold 13 buildings over a 7-month period to pay out those redemptions, and there was a lot of debate at the time about whether that was the right strategy, selling into a falling market. But actually, the market just continued to fall for a period of time. So getting those sales done early actually benefited the investors that were staying in the fund longer term.
Yeah, because normally in these open-ended funds, you hold a certain amount of cash because real estate is in a liquid asset class, just to be able to front these redemptions, so you don't have to sell your prize assets or other assets.
And that's always a debate as well, because investors are giving you cash to invest in real estate, not to invest in cash.
Yeah, you don't want to be sat on it, right?
And that's one of the difficulties that the daily traded funds do have, the retail funds, because they really do require a cash buffer. Being a more institutionally focused fund and having that extended period to pay out redemptions is helpful. It can still be difficult at times when the market conditions aren't with you, but it's more accretive to managing cash and real estate and giving investors what they actually want from their investment into that fund.
You touched on retail fund. Just for people who don't understand, I guess a retail fund is not a retail asset class focused shopping centre high street fund. It's more for mum and dad or me and you type investors who might put $5,000 into a combined fund. So that's what a daily traded retail fund is.
Exactly.
Just for kind of context. So you're kind of thrust into a bit of a spotlight, or you got the exposure to more senior conversations and decision making at a portfolio level, and working out which assets to dispose of, which to keep, which business plans you thought were going to be viable and work through.
Yeah.
So what would you say was one of the core or key kind of differences between being an investment agent and broker compared to being an investment manager? And what is the kind of the education or the skill gap that you have to pick up to be able to make it on the principal side?
I mean, I actually think that the skill gap is probably less today than it was when I made the transition, because a big part of being an investment agent or broker these days is the analytical and the modelling skills that are something that are obviously required client side, but have become much more prevalent on the agency side because of the quality of advice that clients expect these days. And that's a lot been about the professionalisation of the industry as a whole, as real estate's become a more significant asset class since the financial crisis. But at the time, there was a need to change the mindset from, right, I just want to demonstrate a return that the investor is looking for to make them view that asset that I've introduced to them as one that they should be buying to have as part of their portfolio. When you move client side, you're thinking about any particular opportunity within the context of what the fund is trying to achieve, both short, medium and longer term, what the other opportunities are, both within your sector and other parts of the market. You're thinking it's a much more, by definition, a much more strategic approach to analysing a particular investment opportunity, or even looking at what sector you should be going into in the first place.
How did your role evolve from here, and how, after kind of selling out a few of the assets, how, picking the market up and riding the kind of the new wave and upside, how did your role evolve, and what did that look like?
So by 2009, the fund was match fit. Money was starting to come back in, so the focus went very much back onto what do we want to do with this fund, how do we shape it going forward, and what investments do we need to make to achieve those investment objectives. And my role had evolved during the financial crisis to encompass asset management and a bit of fund strategy as well, rather than just being focused on the buying and selling, which is effectively what I was brought in to do originally. And so we were starting to look quite closely at what is now called thematic investing. And we really started to see the evolution of the real estate market away from, well, you can buy office, industrial and retail, and you buy them all for slightly different reasons. One you're buying for yield, one you're buying for capital growth, and the market and the different sectors within the market performing differently, because we really started to see the impact of some of the structural changes which over the past 15 years have really formed the way our real estate market has evolved and is still very much doing so today. So we were seeing likely different performances from the more traditional sectors because of those structural reasons, particularly what was going on in the retail sector, and the more positive impact that was starting to have on the industrial market, but also the growth of new sectors like student accommodation, which was pretty embryonic back in 07, 08, 09. And so really starting to think at the time about, we're positioning this fund for outperformance over the medium term. What sectors do we need to be getting into now? And then really, once we've made those sort of decisions, going in and executing and getting hold of the assets that we thought would allow us to deliver business plan and performance. So I think whether you're working for an investment manager, a property company, what it doesn't really matter. When you're in real estate, your focus is understanding macro trends and trying to work out how they're going to impact on demand for different types of real estate, having the conviction to go and roll out those strategies within those particular sectors. And then when you've developed that conviction and you're rolling out those strategies, then the focus turns to execution. Can I find the right quality of stock? Can I deliver on the business plan once I've executed and bought those assets in? And a combination of all those three things should deliver you good investment performance. And as I say, it doesn't matter whether you're running a real estate fund and trying to perform better than a peer group, or trying to deliver an absolute return, or doing the same thing within a REIT environment or private property. It doesn't really matter. The principles are effectively the same.
You rose to being a fund manager. How did that role shift? And can you just talk to me about that?
It came about because I'd been effectively working on the same fund for a number of years, and sort of been part of the evolution of that fund post financial crisis and the reshaping of what that fund looked like. The fund was going into a growth phase. It had shrunk quite dramatically in size. So to put it into context, it had reached 2 billion around about the sort of time I joined. And by the time we came out of the financial crisis, it was down to about 800-900 million. The market conditions were obviously turning, and money was starting to come into real estate. We all know the low interest rate environment was making the sector very attractive to a whole range of different type of capital. And the fund was set to be a beneficiary of that. Performance had stabilised, and it was well set to capture some of that capital and grow. And therefore, it was going to go through a period of investment. And so I think with my background and history working on the fund, but also being market facing and having a detailed knowledge of the transaction process, and having taken on other roles with regards to asset management and looking after assets within the fund, it was a natural fit for the next phase of the fund's evolution. And this is a fund that's been running since 1971. It's still going today. It's over time people are sort of gatekeepers of this fund, and at that particular time it just made sense for someone with my sort of experience and skill set to be running it.
And so in terms of your role, how did it change? Were you involved with capital raising or client relationship management? I guess less market facing, team management, strategy, planning, looking at these different sectors and allocations?
All of that. And so I've whatever role I've had, I've always kept that market facing piece, and I've always looked after assets. So I still was responsible for the asset management for 5, 6, 7 of the assets within the fund. And that's partly because we kept a lean team, and partly because I always had this nervousness about if you move too far away from what's going on the ground, you sort of lose touch and lose your perspective. So it's always going to be a balancing act. You can't be doing everything, but I think still, however high up you get, I think you still need to have that perspective of what's really going on the ground. So my role at the time was still market facing in terms of sourcing and leading on transactions. Not all of them, and I clearly had a very capable team around me that would help out with that, but also still looking after assets, particularly the bigger projects within the fund. And we had some really big projects that needed to be delivered upon, so I took responsibility for those. But again, the strategy piece, looking longer term, how are we going to make sure that this fund performs over not just 1 year, but 3 and 5 years, and what do we need to be doing now to ensure that happens? And then capital raising, sitting in front of investors, making sure investors, both existing investors, were brought along the journey of what we were trying to achieve with the fund and stuck with us, but also pitching to new money and really giving them a view as to what we were doing with the fund, what we had done, where it had come from, what it was doing, and the opportunities for performance that lay within both the market but the fund itself. We had a couple of very big, basically regeneration projects that sat within the fund that had been in there for 15 or 20 years, that the time was just right to kick them off and deliver them. One in Bracknell, which was the regeneration of Bracknell Town Centre, which was a mixed use but retail led scheme. So we were trying to land big retail anchors at a period of time where the retailers held most of the negotiating cards. And then also Ruskin Square in Croydon, which was a multi-phase office and residential scheme where we kick-started both the office and residential through spec development there. So the role became really multifaceted, both in terms of what I was actually doing day to day, but also the different sectors that we were in, the strategies we were running, and they were really integral to the delivery of the performance and the growth of the fund.
You were with Schroders just over 12 year. What was the kicker, or what was the reason that you decided to leave at the back end of 2018, and what did you leave to go and do?
I wanted to change. I think I'd been there 12 years, as you say. I'd had an amazing time. Worked with very, very, very talented people. Learned a huge amount, but I felt in the latter years, I'd got the fund into a position along with the team where we'd achieved our 5-year plan, which was to grow it. The assets under management within that fund grew substantially. The performance track record was good. So we, as a team, we'd done what we set out to do. For me personally, it was just time for a change. So I left to join a niche investment manager in the opportunistic space that was looking to raise discretionary capital focused on office repositionings. And that was something I'd done quite a lot of at Schroders. We'd run a strategy within the fund where we were focused on emerging London locations. So that meant originally buying in the South Bank and Shoreditch and those sort of locations back in 07 to 12. And then that geography expanded as London grew and Occupy started to move. And then when we were in Whitechapel and Stratford and Battersea and those sort of areas. But that was all about taking tired office buildings and breathing new life into them, making them places that people actually wanted to spend time and work in. And a lot of the stuff that is really on investors' minds today, both in terms of the sustainability piece, but actually creating the space within the working environment that people want to occupy. And so focusing on that, I felt there was a really big opportunity in that space because of the structural changes that was really going on within the world of work and what that meant for office real estate. And so I made that move, but it didn't work out as I'd anticipated. And I think it was a good lesson for me because I reflected quite a lot on it at the time. I stayed there a year and then moved to my current role, and reflected quite a lot about should I have not taken up the opportunity, and then did I move out of it too early? But I think that the key message and the key thing I learned is when opportunities come along, you have to take them, and if they don't work out, you kind of need to look yourself in the mirror and say, no, this isn't the right thing, and make them move on, which is maybe even a harder decision than taking the risk in the first place. So 12 months on, I moved and I joined what was Mayfair Capital and is now rebranded as Swiss Life Asset Managers UK.
So tell me about Mayfair Capital, because it was kind of mid-cap investment management platform, lots of different funds. I know that they had a separate charity fund that was kind of one of the flagships. Can you tell me a little bit about that and then where the Swiss Life piece fits in as well?
Yeah, so Mayfair Capital have been an established name in the UK investment management real estate sphere. The Charities Fund is its flagship fund. It was independently owned, set up around 2003, 2004. And I think it saw that there were that the investment management world was changing, and to continue to grow, it needed a partner. And so Swiss Life Asset Managers acquired it in, I'm going to say 2016.
Yeah, it's 2016.
And that gave the business scope to do more and different things than it had done previously. Swiss Life, classic insurer that spawned an investment management business. So it's investing to get a return for its policyholders and make sure it can pay out claims when they come through. But also as part of an investment management business, using that capital to invest alongside third parties as well. Mayfair became its UK arm. Swiss Life's a huge platform. It's got 100 billion euros under management in real estate. It vies with AXA as the biggest real estate investment manager in Europe, but didn't have any presence in the UK. So that was a natural fit. And I joined the business a few years after to help them focus on value add, and ultimately we moved into operational over the last couple of years.
You joined as head of special transactions or special situations?
I think it was head of special transactions. Yeah, it was.
So what's a special transaction?
Something that isn't office, industrial and retail.
So you joined, and I said at the top of this, I guess there's three buckets of capital, or UK core funds, UK separate accounts and joint ventures, and then UK value add strategies. Which kind of bucket did you focus on, or did you kind of straddle all three and you're finding deals to match against all three areas?
I'm more the latter. The business is really well served by great people who look after the core part of the business, either from pooled commingled funds or through segregated mandates. So my remit was to expand the offer and focus on different parts of the market, both in terms of risk profile, but also to a certain extent sector as well. And that role has morphed into a focus on operational real estate, and I think that's really a reflection of the fact that whilst operational real estate used to be a few niche strategies over here that real estate investment managers probably would invest in indirectly, student, for example, the market, the nature of the industry is changing significantly, and that by definition means that to be a real estate investment manager at the forefront of the industry, you need to have different skills and be able to offer investors different things than you needed to even 5 years ago.
Yeah.
And it's not just alternatives that are operation heavy. Slowly in some cases and more quickly in others, the need to be hands-on, operational and really service-led is spilling over into the more conventional sectors, and office is obviously the prime example of that with what customers expect these days. But retail and industrial will increasingly head that way as well. So for us as an investment manager to capture client capital, we need to be able to offer those operational services for them to want to invest with us,
rather than in an indirect way, siphon off a small part and give it to another, and get access to real estate in an indirect way rather than holding it directly.
Yeah, and I think institutional capital used to access the market via an investment manager, and it would trust that investment manager to pull that capital and invest it in a number of different sectors, but traditionally, only a handful of sectors in a pooled vehicle. But as those sectors have got more specialist and more hands-on, and you need more bespoke skills to unlock value from them, you need to be able to demonstrate an investment manager to that capital that you've got those skills.
Yeah, and we've seen the emergence of kind of single track logistics-focused platforms with a very prominent LP that have built or own part of the top co of an operating partner, and they give them £1 billion to go long, hard and fast into a particular sector. Whereas historically, as you touched on, they might have chucked that in a commingled fund and wouldn't necessarily have had as much control. So I guess the evolution or part of your role going in as special projects and then kind of moving to head of operational real estate is to look at the alternative space that is becoming more mainstream, and then build investment and operational platforms that gives capital direct access to that, whether that is self-storage, student accommodation, healthcare, etc. Is that right?
Yeah, and it's two things. It's to identify key themes in the marketplace. So the technological, environmental, demographic changes that have been influencing the way that people use real estate for a considerable period of time now are continuing to impact on demand for real estate, and that's spawning new sectors. It's changing the way that existing sectors operate, and that's creating opportunities. It's creating threat, but it's creating opportunity. So it's about identifying those sectors and then building solutions to best access those growth parts of the market, which is exactly what we've been doing with self-storage. That is a sector that has a supply-demand imbalance. The demand is being driven by all those structural, demographic, technological changes that we all know and have talked about a lot, and it's growing quicker. The new supply is coming on stream. So from a real estate perspective, it's got the right sort of characteristics to generate sustainable income and income growth over time. And almost regardless of where you are on the risk curve from an investment perspective, those are attractive propositions. So we have invested in the sector. We've built a portfolio of 12 assets, and we've done it in a really hands-on way because we have created a subsidiary to our business, which its only function is to provide operational services to the self-storage portfolio. So we can offer investors a truly vertically integrated solution in the sector, which is quite rare. But as I say, it goes back to what I was referring to. I think for investors to want to give you their capital rather than another, you've got to be able to demonstrate that you can deliver the business plan from start to finish. And so having those operational capabilities in-house effectively is a really big part of that from my perspective.
How do you go about building a portfolio? Do you just buy an existing portfolio, or buy a platform, or buy a business that have kind of got 3, 4, 5, 6 assets? Or do you start picking projects off one by one and proving the concept and scaling it gradually?
So we bought a small business that had 2 units, and we've added to it over time through doing similar transactions, buying 1, 2 unit businesses, but also developing new facilities as well. The strategy we've been running is a value add strategy. We're targeting higher returns. So we're taking risk within the real estate strategy we are developing. We're targeting high returns from that basis. And so those combination of the two, buying existing trading facilities, rebranding them, seeing operational efficiencies by bringing them under a larger roof, and then creating new facilities, again, to tackle the undersupply of space in the sector, has been a really good way of getting the portfolio to the size that we've got it to. And the ambition is to continue to scale that because we think the opportunity is there. I think one of the most interesting things for me has been that it's such a tough fundraising environment at the moment. I mean, the macro environment is, as we know, difficult. And partly because it's an interesting space and investors recognise that, and partly because we can offer that whole solution to them, we've had really good interest and people coming to us and saying, like, how did you do this? We'd be interested in talking to you about it, which, having tried to raise capital for a brown to green office strategy in the middle of the pandemic, it's a welcome change to be in a part of the market that people actively want to get involved in.
There's lots of changes in the market. Historically, it's been quite a defensive asset class, self-storage, to invest in. Death, displacement, divorce. That's when typically people use it. Yeah. But there's a growing wave of new occupiers who are taking space. Can you just shed a little bit of light on that and how you kind of see the occupier base maybe changing?
Yeah, I think that it is morphing into service industrial for micro businesses, particularly retailers. And those businesses are spawning overnight because they have a frictionless access to a customer base through social media. And we provide that service solution to those startups. So whether they've set up a business in their living room and instantly need more space to deal with the running of their business, or they come straight to us, we provide a single price point for them at the end of each month. We're completely flexible. So if their business takes off and goes great guns, they can take permanent space elsewhere. If it doesn't work out, they're not on the hook. We provide an extra level of service because we're there to take deliveries and that sort of thing. So it is becoming a serviced offer for that sector. So the sector itself, as in self-storage, sits very squarely at the heart of all those changes that we're seeing. The changes in the living space, the rise in people renting, co-living, senior living, all is driving demand for storage. And then from a commercial perspective, the changes in the retail world are starting to really, really drive demand in our sector as well. So you've got, that gives you two things. It gives you a diversity to the underlying income, and so you're not predicated on one sector doing particularly well, like the housing market or whatever, but also a really good platform to grow. And that, as I say, that demand is growing quicker than new supply can come on stream. So the ingredients are there for the sector to continue to perform, and it has been a good performer over the last few years.
To get the operational efficiencies geographically, you must be you must be looking at stock that's relatively close together. Where are you? What are the boundaries, or which geographies, areas are you looking to buy kit in?
Yeah, we do try and make sure that we sort of cluster certain geographies. So we can be quite widely spread geographically as long as we've got more than one facility in a particular place. So at the moment we're around the northwest to the east, and then moving slightly further down south. The whole strategy was deliberately not to go around London and the southeast. I'd invested in self-storage when I ran the fund at Schroders, and whilst I think that the whole country is undersupplied and there's certainly opportunity in those locations, it's a more competitive market. And our view was there are pockets of the UK where self-storage is undersupplied, and if you build it, they will come. And we just thought that was a better risk-adjusted strategy than trying to compete with a lot of the big boys in markets that aren't necessarily oversupplied, but where there is plenty of supply. And that seems to have borne out so far. If you look at the take-up in the new facilities that we've opened, and we've opened 4 this year, and they are filling quicker than anticipated. And I think that's partly just because there's not enough self-storage across the UK, but partly because there's very little in the places that we're going into. So that, and the fact that we're buying both land and existing buildings at far cheaper than we would be in more southern locations, but our rental price point is the differential between our rental price point is not as big as the differential between the entry point of acquiring the land or the building. So there's a good value play there as well.
I know it's value add. You said land, buildings, development angle to it. What kind of kit are you looking to purchase? Because I guess converting it into self-storage is one of the strategies or one of the plays, whether that's defunct office buildings, secondary, tertiary locations that have got a big enough plot that you can adequately convert and get additional massing in. What kind of kit are you looking at historically, or to buy?
Well, to date we've bought effectively obsolete industrial units, and instead of knocking them down, we've redeveloped them and fitted out internally to create storage space, and that's been really accretive because the price point was reflected the fact that these sheds weren't fit for purpose as sheds anymore. With what's happened in the market over the past 12 months, we've seen land values come down substantially, and so we're more focused on ground up development for the next phase of growth for the portfolio, because we just think it's the right time to be doing that from an entry point perspective.
So you said you 12 assets. What's the kind of capital value there across the assets, and what are you kind of trying to build it to be in terms of the size and scale?
So it's around 100 million at the moment. We haven't put a limit on how big it could get. That will literally depend on how long the market opportunity lasts, although we do think there's quite a big runway there. The focus at the moment is very much the UK, but there are some very interesting opportunities in Europe, just looking at where some of the European markets are in their evolution. So we think at some point there's a logical next step to expand onto the continent.
Operational real estate is kind of blowing up, and there's, as you said, lots of interest in it. Where are the other subsectors that you're looking at? Because I appreciate it's not just self-storage. You'll be looking at other areas and looking at kind of building platforms. And I guess the idea is to build silos of platforms that you can operate, that you can scale and exit, depending on the investor that you marry up with.
Exactly, yeah. So I think that it's trying to blend those structurally led opportunities. Where is there a fundamental demand that's growing and a supply that is struggling to keep up? So by definition, that means some of the quasi-residential sectors look really interesting, whether that's single family or co-living or senior, and it's just making sure you've got the right approach, and it's the right time from a cyclical perspective as well, and then very focused on the changing nature of work and the opportunity in the office sector, which is partly structural but also cyclical as well, based on what's going on with values in that space.
Do you have like a research team that supports you and kind of gives you some data and numbers, and do you come up with a thesis? How does it work in terms of that relationship with the research team?
So it's very much top down meets bottom up. So we work very closely in collaboration, because when it comes to, there can be some sectors and some ideas that make perfect sense from a top down perspective. But if the values aren't right, it's not the right entry point, then that influences decision-making over when to access that sector. So in multi-let industrials and logistics is a great example. Clearly there's been massive structural pressures over the last few years that have resulted in rental growth and good returns, but the sector has looked, from a standing start, the sector looked expensive to access. So just getting a balance between where's the right place to be over the medium longer term with when do we want to get into that space is important, and that's where the relationship between the various parts of the business really come to the fore.
Can you just give me a bit of an overview of the wider Swiss Life UK funds? Because obviously you kind of head the operational part of it, but just for people who might not have heard of the business or Can you just give a bit of an overview of the platform, the teams? And
Sure. So we are 35 strong in the UK now. Pitch, which is the charities fund, is the flagship fund, and that's going great guns. And we run segregated accounts for a number of investors. We've got one for an investment, two for other investment managers, and one for a private family office that are more income focused strategies. So they're looking to buy best in class real estate and drive value through asset management, but really with a focus on maintaining and enhancing income. So that's the mainstay of the business. We're also running strategies for our European funds, investing as part of their pan-European strategy into UK assets, and again that's cross sector. More recently, it's been in healthcare and PRS.
Interesting. So, established platform, lots of different opportunities, different funds, different capital, and a super talented team there as
Absolutely.
Well. Where do you see the biggest opportunity in this market? We touched on the kind of some of the macro challenges. Fundraising is difficult, but where there's volatility, there's also opportunity. Where do you see that right now?
I think that it was interesting. I was having a conversation with someone the other day who is probably third generation real estate in their family, and he was saying, I'm not sure I'd encourage my kids to go into the sector. The easy money's done, that sort of thing. And I said, I'm completely the other way around. I think there's probably never been a more exciting time to be in the sector, because the structural changes that we've talked about are changing the requirements, the skill sets, the nature of the people within the industry. It's virtually unrecognizable from when I first got involved in it, and that alongside where we are from a cyclical perspective, and that may be relatively short term, but brings opportunity to marry up some of those long term requirements with a point in the cycle where entering is going to be attractive if you're taking a more medium-term view of value growth. So I think the next couple of years are probably as interesting a time if you've got dry powder to invest than there has been since post-financial crisis.
And that's the key thing, isn't it? It's having the capital, the type of capital, the commitment of the capital,
exactly.
And having a kind of a clear thesis around that as well. What advice would you give to people entering the real estate world now, or wanting to access it? And you might have just touched on it already with your previous answer, but is there any additional advice you'd give?
I think it is easier to get ahead before you enter the industry these days because of social media than it was back in the day. And I think that's one of the reasons why we're seeing more people come into the industry that haven't necessarily had a connection with it through family or whatever than we did previously. The people reaching out to me on particularly LinkedIn, who are even at undergrad stage, even still at school, who have an interest in the industry, who are building a network before they've probably even 100% decided to go into the industry, is really interesting to see. And so I think if you are minded to go into real estate, then that is a brilliant way of first understanding whether you really want to do it, because reach out to people on LinkedIn in particular, they're always, most of the time, very receptive. So you'll get a good understanding of what it's like to play in the industry early on. And so I'd really, really encourage that if anyone's thinking about it.
Yeah, it's well documented where the real estate industry as a whole is really keen to kind of push and get people from different backgrounds in, improve the diversity, improve the image, improve the skills, and make it fit for purpose moving forward. So there's an absolutely massive opportunity, and certainly in my experience, as you've touched on, so many people are so willing to give their time, give their connections, and as you touched on at the top of this chat, the benefit of having a sponsor or a mentor is phenomenal. So
and definitely seeing people from a more diverse background. And I don't just mean ethnicity-wise, I mean, socioeconomic, who have this ability to reach out and connect and are doing so, is really interesting to see. And that is going to have a massively positive benefit on the way that this industry operates, and I think is already doing so, and is vital for its continued success, because as we accelerate rapidly away from a relatively small skill set that's needed to succeed in real estate to a very, very wide one to be successful and to generate successful returns out of your assets, we're going to need that diversity of thought.
As we draw to a close, James, the question that I ask everyone who comes on the podcast is, if I gave you £500 million worth of equity, although I've just had Ian Marcus on the podcast and he said you shouldn't be calling it equity, you should be calling it capital. So if I gave you £500 million worth of capital, who are the people, what property, in which place would you look to deploy that capital?
I think that there are a number of sectors at the moment that will at the same time benefit from both the structural changes that are driving the underlying demand and are an attractive entry point. So understandably, self-storage is one that I would very much advocate, both in the UK and in certain European jurisdictions. I think there are some incredible opportunities there. But the office sector as well, I think for a more opportunistic value add style investor, the returns that will be available investing in the office space, if they get it right, both in terms of the asset and have the setup to operate and generate income from those assets over the medium longer term, will provide some of the best risk return opportunities that I've seen in my whole career.
So which ones specifically, and how would you allocate your 500 million?
I'm splitting between the two sectors. And I might allocate some of that directly, I will allocate some of it directly into direct asset purchases, but I think debt strategies as well. There will be a significant need for debt to come in and really fill potentially a hole, especially in some of the more risk-on assets that need repurposing over the coming part of the cycle. So I think I would allocate that capital in both equity and debt strategies, but in those two sectors in particular.
And I know you're a very well-connected man. Who across the industry would you bring on the journey or add to your team to help you deploy that capital? Well,
alongside the existing team, there are a number of people who I think would be excellent. But we're talking to most of them at the moment, so I can't really divulge. But I think that there are some excellent people who have really spotted the trends that are out there and focused in on particular areas of the market and become best in class in those areas. And I think working with those people is going to benefit us and our capital partners the most.
And you're not able to say who they are? No, there's a conflict. Okay, well look, James, thank you so much for joining me on the podcast today. It's been fascinating finding out a little bit more about your background, stories, views, where you see the opportunity, and excited to see what you and the team go on to achieve.
Thank you very much for having me.
Thank you. Thanks for listening to this week's episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Give us a rating, like, or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests that we should have on the show or areas of the market we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit leadership and future leadership hires for real estate owners, funds, investors, and developers. So if you're looking to hire top talent for your business, head over to the website www.rockborn.com, where you'll be able to find a wealth of information, or feel free to drop me a message on LinkedIn. Have a great day wherever you are, and I look forward to catching you next time.